Investing can feel intimidating when you're just starting out, but what if technology could do the hard work for you? That's where robo-advisors come in. These digital platforms use algorithms to build and manage your investment portfolio automatically, making investing easier and more accessible than ever. But while robo-advisors can be a great tool for beginners, they're not perfect, and it's important to understand both the advantages and the drawbacks before you jump in. In this video, I'll break down exactly what robo-advisors are, how their fees work, and when they make the most sense to use. Stick with me until the end, and don't forget to like, subscribe, and hit the notification bell so you never miss more beginner-friendly investing tips. Investing can feel overwhelming when you're just starting out. Between the endless jargon, complicated charts, and constant talk about beating the market, many beginners feel paralyzed and unsure of where to begin. That's where robo-advisors come into the picture. Over the past decade, they have emerged as one of the easiest ways for newcomers to dip their toes into investing without getting lost in the complexity. But like any financial tool, robo-advisors have their strengths and weaknesses. To decide whether they're right for you, it's important to understand what they are, how they work, and the pros and cons of relying on them to manage your money. What exactly are robo-advisors? At their core, robo-advisors are digital platforms that use algorithms to provide automated financial planning and investment management. Instead of working directly with a human financial advisor who makes personalized recommendations, you interact with an app or website. After answering a few questions about your goals, risk tolerance, and time horizon, the robo-advisor automatically builds and manages a diversified portfolio for you, usually made up of low-cost exchange-traded funds, ETFs. Think of it as putting your investing on autopilot. The technology behind robo-advisors is designed to make smart, evidence-based investment decisions without requiring you to understand the details of asset allocation or market timing. Platforms like Betterment, Wealthfront, and Vanguard Digital Advisor are among the most well-known, and they cater especially to beginners who want simplicity and convenience. Why robo-advisors appeal to beginners? For someone new to investing, the appeal of robo-advisors is obvious. They remove much of the stress that comes with trying to figure everything out on your own. Instead of having to research individual stocks, monitor the market daily, or worry about making costly mistakes, you simply set up an account, deposit your money, and let the algorithm do the work. Another key benefit is accessibility. Traditional financial advisors often require a high minimum investment, sometimes $100,000 or more, putting them out of reach for young or first-time investors. Robo-advisors, on the other hand, usually allow you to start with just a few $100s, or in some cases, no minimum at all. For beginners who don't have large sums of money, this makes the investing world much more approachable. The pros of using a robo-advisor. One of the biggest advantages of robo-advisors is cost. Human advisors typically charge fees around 1% of assets under management, but robo-advisors usually charge between 0.25% and 0.5%. That difference may seem small, but over decades, lower fees can mean tens of thousands of dollars more in your pocket. And because most robo-advisors invest in ETFs, which already have low expense ratios, your overall investing costs remain very affordable. Simplicity is another major strength. You don't need to worry about choosing the right stocks or trying to predict the market. The robo-advisor builds a diversified portfolio automatically, spreading your money across multiple asset classes, such as U.S. stocks, international stocks, and bonds. This diversification reduces your risk compared to putting all your money in one place. Robo-advisors also automate tasks that many beginners overlook but are essential for long-term success. For example, they handle rebalancing, which means adjusting your portfolio back to its original target allocation when market fluctuations push it off balance. Some even offer tax loss harvesting, a strategy that helps reduce the taxes you owe by selling investments at a loss to offset gains elsewhere. These are strategies that professional investors use, but a beginner would rarely know how to implement on their own. The cons of using a robo-advisor. Despite all the advantages, robo-advisors are not perfect. One of the main drawbacks is that they lack the personal touch of a human advisor. If you have complex financial needs, such as estate planning, tax strategies beyond basic harvesting, or advice on managing business income, a robo-advisor won't provide tailored guidance. The algorithms are designed for general investing strategies, not for nuanced, one-on-one financial planning. Another limitation is control. Some investors prefer to be hands-on with their portfolios, choosing specific companies or industries they believe in. With robo-advisors, you typically don't get to pick individual stocks. Your money goes into a pre-built mix of ETFs. And while this is great for beginners who want simplicity, it can feel restrictive if you like to have a say in where your money is invested. Fees, while lower than traditional advisors, are still higher than going completely DIY. If you're comfortable learning the basics of investing and buying your own index funds through a brokerage account, you could avoid robo-advisor management fees altogether. For some people, that small extra cost is worth the convenience, but for others, it might feel unnecessary once they've built confidence in managing money themselves. When a robo-advisor makes sense. Robo-advisors make the most sense for beginners who want to start investing but feel overwhelmed by the complexity of doing it themselves. If you don't have the time, interest, or confidence to learn about asset allocation, rebalancing, and tax strategies, then letting an algorithm do the heavy lifting is a smart move. They're also ideal if you're starting small. Instead of waiting until you have thousands of dollars, you can open an account and begin investing with as little as a few dollars a day. This helps you build momentum and establish the habit of investing early, something that's far more important than trying to time the perfect entry point into the market. On the other hand, if you have a more advanced financial situation or want to be very hands-on with your money, a robo-advisor might feel limiting. In those cases, a combination approach can work. Use a robo-advisor for your core investments, while experimenting with a small portion of your portfolio in individual stocks or other strategies. And that's a breakdown of the pros and cons of robo-advisors for beginners. They offer simplicity, automatic diversification, and low barriers to entry. But they also come with management fees and less flexibility compared to doing it yourself. The key is knowing whether a robo-advisor fits your goals and comfort level with investing. If this video helped you, make sure to hit that like button, subscribe to the channel, and turn on notifications so you'll always get clear, practical investing advice. Thanks for watching, and I'll see you in the next one.